Howdy, Jacob here. Today I'm looking at Medical Properties Trust, ticker symbol MPW. So before I get into everything I go over, I just want to say that what I produce here is definitely, of my opinion, 100%. Have to do your own research and everything. But hopefully this is like the start to, um, what your analysis should be because um, I just don't understand. And if you don't know, Medical Properties Trust is a REIT, a right, real estate investment trust, and it's just not something that I fully understand. And so I'm going to go through the business like I usually do, and then I'm going to explain a couple other things, and then I'm going to leave it off for you to finish off the analysis on what to do from your perspective. And so as always, I'm going to go through the financials. So $2.1 billion market cap, $10.6 billion enterprise value. From my perspective, huge amount of net debt I'm seeing here um, that I don't like to see. I usually like to see market cap and enterprise value similar, meaning they have similar amount of cash on hand as debt, but this is a right. And so, there's going to be, if you invest in that, like, I don't own a house, but obviously took a mortgage on it. Um, well, not obvious, but as young as I am, took a mortgage on it. The interest rates were, pretty low at the time, and then so I understand that when you go into real estate, especially as a right, you own these properties, you're going to go into debt in a lot of them to get, you'll have a lot of interest payments, but then you'll also have hopefully larger rent payments or rent um, revenues than interest payments. But first thing I see, I don't really like, but I don't really know a whole lot about rights, so I tried to look at some similar ones. And so I pulled up Simon Property Group, which does more like mall-like things. And I was seeing 52.7 billion on market cap, 76.9 billion enterprise value. So it's still a lot of debt, but not like 5 times debt. But they have the same story of low cash, high long-term debt. American Tower Corporation, almost $100 billion market cap, $133 billion enterprise value, good amount of net debt there. And this was one of the most, growth companies alive on the, if you've ever read, I don't remember what it's called, but it has to do with like 100 to 1, where you go up, 100 times on the stock. And so 34 billion long-term debt, 2 billion cash. So this just seems like, and again, those weren't necessarily in the hospital business, and so this one is in the healthcare real estate industry. Almost 20 billion market cap, 32 billion enterprise value, good amount of net debt, almost no cash, 12 billion long-term debt. So that does seem to be a common theme for this industry. So I just wanted to make sure that was enterprise value is always a little bit higher than market cap. I will say MPW's is a lot higher. If we're looking at multiplicatively, we're looking at almost 5 times their enterprise value is nearly 5 times their market cap. The other ones were maybe 50% greater. So keep that in mind. But the other ones did not have this growth where in 2013, 243 million in revenue to today, 1.5 billion in revenue. So we're looking at almost 7 times their 7 times revenue growth over a 10-year period, exponentially crazy growth. So currently a 24.7% dividend yield. Sounds absolutely fantastic. And I also looked up the way that dividend yields work. Well, I looked it up here first. So the last 5 years, it's been about $20 a share. And so 88 cents on $20 a share is 4 to 5% dividend yield. So that sounds a lot more reasonable, but then it's dropped like crazy recently. I presume it had to do something with the debt. So I actually wanted to do more research on it. And so you can see that the company has previously announced in July 3 hospitals for sale, and then sold 4 remaining facilities in Australia. And the weird thing about it, right, is when I do my assumptions, I obviously have the dividend and then, present value of earnings and free cash flow. But The dividend is something that I'm not going to look into today. You're going to have to do that on your own, because the way that they pay it out is not how any other company would pay it out. It's not looking at free cash flow and saying, I have 100 million in free cash flow. I'm paying out 200 million. I clearly can't afford that. That's not how REITs work. REITs have to pay out 90% of their funds from operation. And so the way to calculate that is essentially their net income plus their depreciation, amortization, and then losses from property. And then you subtract out any gains on property sales and any interest income. So in most cases, um, just if you want to do a quick check, obviously this isn't going to be 100% accurate, but if you just add net income to, or depreciation and amortization to their net income, you'll get roughly close to their funds from operation, unless they had, a huge loss or gain on a property, and any interest income. So um, keep that in mind. And so if you, that's going to be tough to, calculate out that the dividend payouts, since it is so related to the funds from operation. And so that's interesting. And then also, you have to balance out the reality of business situations, which is you fund a dividend through cash flow. And so if you don't produce free cash flow and you pay out a dividend, there's two ways to fund it: issuing shares, issuing debt. And so, as you can see here, in the last 10 years, and then again, I'll go to the most recent quarter later, but no, no positive free cash flow. And again, acquisitions are incorporated into their capital expenditures, so that is part of the business. But I looked at American Tower and Simon Group, um, and the other hospital business we looked at, and they all had positive free cash flow with that. So keep that in mind. And you can see they've just been issuing shares, issuing debt, issuing shares, issuing debt, just a bunch to fund acquisitions and paying their dividend. And so in the most recent quarter, or most recent 10Q, we have not trailing 9 months where 2022 was negative, and then we're actually getting into positive 135 million output, but that 135 free cash flow is nowhere near the dividends they pay out of 524 million. And so again, there's not a whole lot of, like, the way that they're going to have to fund that is through either issuing shares, issuing debt, or selling off parts of their business, which we see that they've already been doing through their most recent quarterly uh, news release. Is that sold 3 hospitals to get 100 million, and then 4 facilities in Australia. So the big thing that you're going to have to do here, which I will not do just because I don't understand this type of business well enough, is you're going to have to calculate what you think the funds from operation will be, and then calculate on your perspective how much safety you need, given that the company is just going to be selling off parts of their business to fund, to be able to fund uh, their dividend, because obviously that's going to hinder their growth abilities and everything. But I did write down some notes. So this is not quite an in-depth research, but I did somewhat research. And so they have 2 operators, Stewart and Circle, that make up 19.8 and 10.8% of the business. And then geographically, 21% are in the UK, 10% in Texas, and then other regions are less than 10%. 63% are in acute care hospitals, 13% behavioral health hospitals, and then sub 10% other hospitals. And then because the debt was so important here, I wanted to take a snapshot of the debt so you could look at it, or just look at their most recent 10Q, and we see that they have 1.3 billion in revolving credit, and then a lot of unsecured notes due at different periods in time. I will say a lot of their notes are due later down the road, which is good to see. So they might be able to refinance that. But yeah, this is going to be something you're going to have to do on your own to balance out what their funds from operation is with all the debt that they have. So thank you.